The Commerce Department will reveal retail data that is going to be revealed during the month of November ahead of tomorrow's open. And economists are expecting that there will be more signs that consumer spending is driving the economic growth. The latest estimates forecasting month-over-month growth of 0.5% in the month of November, continuing the theme of month-over-month gains we saw in both September and October. Shelby McFaddin, investment analyst at Motley Asset Management, is joining me now. Good morning.
Morning. Thanks for having me.
It's great to have you on the show. Let's just dive into this topic right now. What expectations for the retail sales data that are being released on Tuesday that you think investors should be on the lookout for?
Sure. I mean, at this point, we're kind of looking for something a little tepid, right? We don't want anything to be too robust because then that could be a signal to the Fed that says, hey, things are looking a little bit healthy. But we also don't want anything to be too slowed down. The same way we kind of look at PPI. No one wants to get excited about PPI being a little bit too low because that signals that, buyers are looking to slow down a bit. So I think coming out of this next set of data, it'll be a little bit too early to get too much of the holiday shopping. So I imagine it'll be a little bit cleaner than normal. But I think investors should want something that says that consumers are settled into the current economic conditions, nothing too robust, nothing too slow, but also not to get too hung up on it because we are in a sort of interesting season and the retail data doesn't always reflect exactly what people need. It's a little bit more discretionary.
Shelby, can you elaborate a little bit more on what you see right now with the current economic environment and how it's impacting consumer spending during the holiday season and which retail segments might fare better under these conditions?
Yeah, so what we're seeing right now is sort of a continuation from what we've seen out of sort of the earlier part of the year and late in 2023, which is a deferral of the large discretionary purchases. And so because we are in Q4, we're in the holiday season, we might see people getting some more things like washing machines or things like that because they are marked down. So we probably saw a bit of a deferral of purchases from the earlier part of the year waiting for those sales. But on the whole, if we sort of strip out inflation and compare, we're seeing a bit of reduction there. The way that we approach it at Motley Asset Management is bottom up. So we're looking for those companies that are going to be the most competitive. They're going to have the strongest sales when everyone is in the same storm. They're offering the most value. They have bigger scale. They have high quality operators because then we don't have to time the market when the macro component comes back to benefit everyone that's in play.
Now, when evaluating retail stocks through a bottom-up approach, what specific qualities or metrics do you specifically look at in a high-quality operator, and how do these indicators signal long-term success in this sector?
Sure. So when we're looking at operators, that sort of falls under one of our 4 pillars of quality that we call management, culture, and incentives. So we're taking a look at one, what's their incentive structure? How are they paid? What is motivating them? And then we're also looking at things like what exactly is the ROI under this particular operator? How do the CEO and CFO work together? Have their plans succeeded? How has the M&A paid off for the business? So we're really drilling into those subjects because it can get really easy with some of the mega scale operators to just kind of ignore what they do with extra cash. Oh, they're sending a dividend, they're doing some buybacks, that's great. But we really have to look in and see what else could they be doing? Are they reinvesting in the business? And what are they buying? Just because it's affordable because they're large doesn't necessarily mean it's paying off. So we're taking a really good look at that to make sure that they are maximizing what they could be doing for the business and for shareholders.
Now, NYSE listed company Walmart has consistently demonstrated resilience and strong performance despite economic headwinds. What would you say differentiates this company from its peers, and what would you say some of your stock picks are?
I think what differentiates Walmart from its direct peers really comes down to the value that they offer and their operators. So when we look at Walmart, they are very agile. They move quickly with the environment. So they are able to be very flexible with workforce. Because of their scale, they're also able to very quickly sort of wind down any partnerships that might be sort of sucking through any extra profit that they want to see come down to the bottom line. So they're able to move very quickly. They also, because of the scale of their supplier network, can move quickly when it comes to adjusting prices to bring that value back to their customers. And that's really something that sort of glues them to the American public, is that between Walmart and Costco, it's clear that they are looking out for customer first. So when we sort of set aside be quality issues that might hit certain regions, which is something that we need to hold management accountable for. On the whole, they are trying to make sure that the average American family can access not only their necessities, but some of the discretionary purchases that they might want to, because just having shelter, food, water, soap is not enough to actually bring a full smile to the heart. They want their customers and households to be able to treat themselves as well.
And what impact do you think this retail data that's released tomorrow will specifically have on consumer-focused stocks, or ETFs for that matter?
Yeah, I think it's going to be similar to what we have seen when CPI would come out and what that would largely do to small caps versus large caps. I think if the data leans any one direction, we'll probably see in the first few hours of trading an overall sort of smackdown, if you will, and then an adjustment for realizing that there are going to be outliers. There is a chance that the market, knowing companies like Walmart and Costco tend to fare better, that they kind of leave them out of it a bit. But it really all depends on sort of how the market sees that risk. We know that the market sometimes assesses things differently than we do, even in the most well-known names. So I would imagine that if things are more than a little slow to the point where we're starting to get concerned about missing that soft landing, then we could see things come down a bit. If things are more than a bit aggressive, then we could also see things come down a bit, because now we're looking at that section of, is the Fed going to potentially turn, slow down in the decreasing of rates. So if it's anything but just right in that three bears scenario, I think we'll see a movement either direction.
A lot to look out for. Thanks again, Shelby McFaddin. She is part of the investment analyst at Motley Full Assessment Management. Thank you.